Let us now look at an example here. There's a company A that has purchased 5% bond at par value of $1 million at the beginning of the year, and the interest rates have increased and thereby the market value of the bond has declined by 20,000. So the question asks is that we need to find the bond effect on the financial statements under each of the classifications. So let us see, if this security was classified as held to maturity, what would have been the associated impact on the balance sheet. So if this was held to maturity, this is actually reported at book value, which we have learned earlier. So the book value is $1,000. So nothing changes as such because of this decline in bond by 20,000. What about the income statement impact? We have noted earlier that the income statement will include the realized gains and losses as well as the interest income. So here the interest income is basically 5% of 1 million. So this comes out to be 50,000. So this is what your interest income will be reported in the income statement when the classification is held to maturity. Now let's look at if this security was classified as trading security. So under the trading security, we understand that in the balance sheet it will be reported at fair value, and the fair value is $980,000. So this is your fair value. And what about your income statement? In the income statement, we have seen that dividend income, interest income, realized gains and unrealized gains and losses, all of them actually flow here. So here what we have is the interest income for sure. This is 50,000 like above, and then there would be an element of unrealized loss, which is the difference between 1 million and this 980 million, that is a loss of 20 million. So this is a loss, so thereby a net effect would be something like $30,000 here. Now let's look at the third one, which is the available for sale. So in available for sale, you'll note that the balance sheet actually reports on the fair values. So here also again this will be 980,000, and in the income statement unrealized losses are not carried in the income statement. So the only thing that will be there in the income statement will be interest income to an extent of 50,000, and this unrealized loss of 20,000 is actually adjusted under the shareholders equity section directly.